The most accurate buy-sell signal indicator. Hey guys, welcome back to another episode. In this video we will be going through our very simple, yet profitable 200 SMA demand index hidden divergence system. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. SMA Demand Index Hidden Divergence System. As the name suggests, Demand Index Divergence Indicator is a divergence trading system that can be useful in trading trend-following setups and reversal trading setups. This system is based on the moving average of the price data and helps investors understand whether the bullish or bearish movement in the price is strengthening or weakening. And now, let's understand the working of 200 SMA Demand Index Hidden Divergence Trading Strategy. Demand Index Divergence Indicator Overview. Demand Index Divergence Indicator is displayed with a histogram which graphs the difference between two moving average of price data. Another moving average is applied on this histogram which is called signal line. When the histogram formation is above the zero lines, then the market is in an uptrend, and when the histogram formation is below the zero lines, then the market is in a downtrend. The crossover of the histogram line and the signal line is also an indication of the change in direction of the trend. Demand Index Divergence Indicator Explanation. Demand Index Divergence Indicator also measures the momentum of the price data. When price makes a lower low, but Demand Index Divergence Indicator makes a higher low, it's called hidden bullish divergence. Conversely, when price makes higher high, but Demand Index Divergence Indicator makes lower high, it's called hidden bearish divergence. Hidden divergence is an indication that the ongoing trend is strong and the trend can continue. Traders should trade in the direction of divergence by using crossover of histogram and signal line as a trigger. Alternatively, traders can apply trend lines breakout and breakdown for taking entry. Here are other examples of the Demand Index Divergence Indicator trading. $200 Simple Moving Average. What is the 200-day Simple Moving Average? The 200-day Simple Moving Average, or SMA, is considered a key indicator by traders and market analysts for determining overall long-term market trends. The indicator appears as a line on a chart and meanders higher and lower along with the longer-term price moves in the stock, forex, commodity, or whatever instrument that is being charted. The 200-day SMA seems, at times, to serve as an uncanny support level when price is above the moving average, or a resistance level when price is below it. The 200-day SMA, which covers roughly 40 weeks of trading, is commonly used in stock, forex, and commodity trading to determine the general market trend. As long as a currency or stock price remains above the 200-day SMA on the daily time frame, the price is generally considered to be in an overall uptrend. And vice versa, as long as a currency or stock price remains below the 200-day SMA on the daily time frame, the price is generally considered to be in an overall downtrend. One frequently used alternative to the 200-day SMA is a 255-day moving average that represents the trading for the previous year. As a very long-term moving average, the 200-day SMA is often used in conjunction with other, shorter-term moving averages to show not only the market trend, but also to assess the strength of the trend as indicated by the separation between moving average lines. For example, comparing the 50-day SMA and 200-day is relatively common. When moving average lines converge, this sometimes indicates a lack of definitive market momentum, whereas the increasing separation between shorter-term moving averages and longer-term moving averages typically indicates increasing trend strength and market momentum. Death cross and golden cross. The 200-day simple moving average is considered such a critically important trend indicator that the event of the 50-day SMA crossing to the downside of the 200-day SMA is referred to as a death cross, signaling an upcoming bear market in a stock, forex, index, or other investment. In like fashion, the 50-day SMA crossing over to the upside of the 200-day SMA is sometimes called a golden cross, referring to the fact that a stock is considered golden or nearly sure to rise in price once that happens. Here are other examples of the 50 SMA and 200 SMA trading strategy. SMA Demand Index Hidden Divergence Trading Strategy. In this strategy, traders should trade in the direction of 250 simple moving average trend by using hidden bullish divergence signals and hidden bearish divergence signals. Demand Index Divergence Indicator is a custom indicator. However, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Buy conditions. First, golden cross, or the 50 SMA above 200 SMA. Second, the price must trade above the 200 SMA. Third, price forming lower high and lower low structure. Fourth, hidden bullish divergence in price and demand index divergence indicator. Fifth, bullish crossover of the histogram line, and the signal line is a trigger for long trades with the stop loss behind the last low. Here are other examples of the buy conditions. conditions. First, death cross, or the 50 SMA below 200 SMA. Second, the price must trade below the 200 SMA. Third, price forming lower high and higher high structure. Fourth, hidden bearish divergence in price and demand index divergence indicator. Fifth, bearish crossover of the histogram line and the signal line is a trigger for short trades with the stop loss behind the last high. Here are other examples of the sell conditions. Always remember, the trend is your friend, so whenever you can get a signal that the trend will continue, then good for you. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.